Attorney Chris Vernon here. I want to chat with you about what I saw in Puerto Rico last month. It's October 3rd. I was there a couple of weeks ago and talked to UBS former advisors, talked to investors, talked to attorneys, and it's really troubling what I'm seeing down there. And you're seeing it reported all over the news, and I just want to give it to you in video format. And that is that it appears that at least UBS and probably some other firms were putting their investors into closed-end bond funds that had a lot of Puerto Rican bonds in them for various reasons. They were leveraging those funds, meaning they were borrowing within the fund, they were borrowing money to put more bonds into the fund, and that's money that would have to be paid back at some point through liquidations or appreciation. And then after those bond funds were sold to the UBS and other clients, UBS was recommending, or their financial advisors were recommending, that those same investors invest more through more borrowings outside of the fund and borrowing money directly from UBS or other firms that they were working with so that they can buy even more of those bond funds. And so it's leverage on leverage. Double leverage is another way to say it. And what happens when you have that situation is if the bond funds go down in value, then the collateral used to repay the loans is less. And if investors start to pull money out because they see the price declining, the price often declines more because some of those good bonds, or what's left of the good bonds, have to be sold off to pay investors, and the price goes down further, at which time the brokerage firm says, hey investor, you need to pay back this loan, and we have the power to liquidate your portfolio if you don't immediately pay it back. So investors, unless they have a lot of available cash to pay back that loan, are caught and they can't do anything about it. And they watch their portfolio actually be liquidated by their own brokerage firm, their own trusted firm, in order to pay back money owed to that firm. And in some egregious cases, what you're seeing now is letters going out to investors who are being told not only is their portfolio gone because of this strategy, but now they supposedly owe money over and above their losses back to the firm to fully repay the loan. This is a real tragedy and involves a ton of money. And what is so tragic about it is that some of the things that are being done in Puerto Rico and some of Puerto Rico's natural assets, I think, will help over a number of years to bring it back. But unlike investors who are simply holding Puerto Rican bonds, these investors that I've been talking about are not able to do that because their portfolios are gone, their assets are gone, and they can't hold on for the better times and wait until those bonds mature, hopefully without default, and they get their money back. So it is a situation in which a lot of, we believe, fixed income investors thought they were buying what are traditionally perceived as safe bond funds, and in reality what they ended up with was extremely speculative portfolios that used leverage in order to what we call juice the returns for income-starved investors. So we'll update you additionally on this as we learn more, but I just want to give you this video update of what you're probably already reading about in the various newspapers throughout Latin America and in the U.S. now as well.